Imagine delivering millions of dollars worth of products to one of the world's biggest companies. The goods have arrived. The customer accepts the delivery. The invoice is approved, but payment won't arrive for another 90 days. For most businesses, that delay creates a serious problem. Employees still need to be paid. Suppliers still expect money. Factories must continue operating. Cash can't wait 90 days. Greensill Capital promised to solve that problem. Founded in 2011 by Australian financier Lex Greensill, the company claimed it could make global commerce faster by allowing suppliers to receive payment almost immediately, instead of waiting months for customers to pay. It sounded simple, almost invisible, yet within a decade, Greensill had become one of the fastest-growing financial companies in the world. Governments praised its innovation. Major banks partnered with it. Global investors poured billions of dollars into its financial products. Industrial giants relied on its funding. SoftBank invested approximately $1.5 billion into the company. At its peak, Greensill helped finance hundreds of billions of dollars in business transactions across dozens of countries. To many people, it didn't even look like a finance company. It looked like technology quietly making global business more efficient. The idea appeared almost impossible to criticize. Suppliers received money faster. Large corporations kept their normal payment terms. Investors earned returns from financing real business activity. Everyone seemed to benefit. But hidden beneath that elegant system was one critical assumption. The invoices financing billions of dollars in transactions actually had to represent real, collectible business payments. The moment that assumption began to fail, one of the fastest-growing financial companies in the world would collapse almost overnight. To understand Greensill, you first need to understand one ordinary business invoice. Imagine a small steel manufacturer supplying $1 million worth of steel to a global car company. The steel is delivered. The quality is approved. The customer accepts the shipment. An invoice for $1 million is issued, but the payment terms say 90 days. For the car manufacturer, that's perfectly normal. Large corporations often negotiate payment terms of 60, 90, or even 120 days. Holding on to cash for longer improves their own cash flow. But for the steel manufacturer, waiting 90 days creates a problem. Employees must still be paid this week. Suppliers expect payment. Electricity bills arrive. Raw materials must be purchased for the next production run. The company has completed the work, but it still doesn't have the cash. This is where Greensill entered the transaction. Instead of telling the supplier to wait 90 days, Greensill offered something different. It would pay the supplier almost immediately. Imagine the invoice is worth $1 million. Greensill might advance approximately $990,000 within days. The supplier receives cash immediately. Business continues operating normally. 90 days later, the car manufacturer pays the full $1 million when the invoice becomes due. Greensill receives the payment. The difference between the amount advanced and the amount collected becomes its profit. Everyone appears to benefit. The supplier receives cash immediately. The customer keeps its preferred payment terms. Greensill earns financing income. But Greensill didn't simply hold thousands of invoices until they were paid. That would require enormous amounts of capital. Instead, it bundled thousands of corporate invoices together, creating large pools of financial assets. Those pools were then sold to investment funds and institutional investors looking for relatively stable returns backed by everyday business transactions.
Suddenly, an ordinary invoice wasn't just an invoice anymore. It had become an investment product purchased by investors around the world. As long as those invoices represented genuine business, real customers, and real future payments, the entire system worked remarkably well. But the entire financial machine depended on one assumption. Every invoice had to represent real business, real customers, and real future payments. The moment that assumption became uncertain, the entire system would begin to unravel.
For years, Greensill's model appeared remarkably safe. Traditional supply chain finance is built around one important condition. The supplier has already delivered the goods. The customer has accepted them. The invoice already exists, and payment is legally owed. That makes the financing relatively straightforward. But Greensill wanted to grow much faster. Eventually, financing existing invoices wasn't enough. The company began expanding into something far more ambitious: future receivables. To understand the difference, imagine the same steel manufacturer. Instead of financing an invoice for steel that has already been delivered, Greensill finances steel the company is expected to deliver over the coming months. No invoice exists yet. The delivery hasn't happened. The payment hasn't been approved. The future business is only expected to occur. These are known as future receivables. Future receivables aren't automatically fraudulent. Many businesses can reasonably predict future sales based on long-term customer contracts, historical purchasing patterns, or recurring commercial relationships. Under carefully controlled conditions, future receivables can be financed, but they introduce a completely different level of risk. A traditional invoice represents money already owed. A future receivable represents money that might be owed someday. One depends on completed business. The other depends on future expectations. Greensill increasingly blurred the line between those two worlds. The larger the financing became, the more the system depended upon future business actually occurring. Yet investors continued buying Greensill's financial products. Why? Because another layer of confidence sat beneath the entire system: insurance. Many of the invoice-backed assets purchased by investors were protected by trade credit insurance. If customers failed to pay, the insurance was expected to absorb much of the loss. That additional protection made Greensill's products appear even safer. By now, the financial machine had evolved far beyond simply helping suppliers receive early payment. It depended on future business, investor confidence, and insurance remaining in place. Three assumptions supporting hundreds of billions of dollars in financing. The moment even one of those assumptions failed, the entire system would begin losing its foundation. For years, Greensill's financial machine continued expanding. Suppliers received cash. Large corporations continued extending payment terms. Investors continued purchasing invoice-backed assets. Everything appeared to function exactly as designed. But beneath that success, one critical layer supported the entire system: insurance. Imagine an investor purchasing millions of dollars worth of invoice-backed assets created by Greensill. The investment appears relatively safe, not only because it is backed by business invoices, but those invoices are also protected by trade credit insurance. If a customer fails to pay, the insurer is expected to compensate much of the loss. That additional protection gives investors confidence. It also makes the investment funds willing to continue buying more invoice-backed assets from Greensill. As long as insurance remains in place, new money continues flowing into the system.
But insurance companies constantly reassess risk. They review customer quality, concentration risk, financial conditions, and the likelihood of future claims. By 2020, one of Greensill's most important insurers, Tokio Marine, had become increasingly concerned about the growing risk profile of parts of Greensill's business, particularly financing linked to future receivables and large exposures connected to companies within Sanjeev Gupta's GFG Alliance. Rather than extending the insurance cover, the insurer decided not to renew key policies when they expired. That decision changed everything. Without insurance, many institutional investors were no longer willing to purchase Greensill's invoice-backed assets. The financial machine depended on continuously selling those assets to generate new funding. When investor demand slowed, Greensill's ability to finance new invoices immediately began shrinking. Then another major blow arrived. Credit Suisse, which managed investment funds holding billions of dollars in Greensill-linked assets, froze those funds in March 2021 after concerns over the insurance protection and the underlying assets. Investors could no longer access their money. Confidence evaporated almost immediately. Within days, the funding engine that had powered hundreds of billions of dollars in global supply chain finance began running out of cash. The business hadn't suddenly forgotten how to finance invoices. It had lost something even more important: the confidence that allowed the entire system to keep funding itself.
Once investor confidence began disappearing, Greensill faced a problem its business model was never designed to survive. Cash was constantly flowing in one direction. Suppliers expected immediate payment. But Greensill could only provide that cash by continuously raising new funding from investors purchasing its invoice-backed assets. When those investors stepped away, the flow of new money slowed dramatically. Imagine trying to operate a railway where every arriving train depends on another train leaving the station first. The moment departures stop, the entire network begins backing up. Greensill's funding system worked in much the same way. Without new investors, there was no fresh capital to finance new invoices. Suppliers could no longer receive immediate payment. Confidence spread through financial markets with remarkable speed. Major corporate clients began searching for alternative sources of financing. Banks reduced their exposure. Business partners questioned whether Greensill could continue operating. At the same time, one of Greensill's largest client groups, Sanjeev Gupta's GFG Alliance, came under increasing scrutiny because a significant portion of Greensill's financing was connected to companies within the group. As uncertainty grew, questions emerged about the quality of some underlying assets supporting Greensill's funding model. Potential new investors became even more cautious. Attempts to secure emergency financing failed. Without insurance, without sufficient investor demand, and without access to enough new funding, the business rapidly ran out of options. On 8 March 2021, Greensill Capital entered administration in the United Kingdom. Less than 10 years after its founding, one of the world's fastest-growing financial companies had effectively collapsed. But Greensill's failure didn't stop at its own offices. Companies that had depended on its financing suddenly needed alternative sources of working capital. Investors faced billions of dollars in frozen and uncertain assets. Banks, regulators, and governments began assessing the wider consequences. The company that promised to keep global commerce moving had itself become one of the biggest disruptions to global finance. Greensill's collapse didn't end with its administration. It marked the beginning of years of investigations, lawsuits, regulatory reviews, and financial losses spreading across multiple countries. Investors who had purchased Greensill-linked financial products suddenly faced billions of dollars in uncertain recoveries. Among the largest affected institutions was Credit Suisse. The Swiss bank had managed approximately $10 billion of investment funds linked to Greensill-originated assets. When those funds were frozen, thousands of institutional and private investors suddenly lost access to their money. Credit Suisse spent years attempting to recover assets while facing intense criticism over its risk management and investment oversight. SoftBank, which had invested approximately $1.5 billion into Greensill through its Vision Fund, effectively saw most of that investment wiped out. Attention also focused on Greensill's largest corporate relationships. GFG Alliance, the international industrial group controlled by Sanjeev Gupta, had relied heavily on Greensill financing to support large parts of its global operations. When Greensill disappeared, many companies within the group faced severe refinancing pressure as they searched for alternative funding. Meanwhile, regulators in multiple jurisdictions began investigating Greensill's lending practices, its use of future receivables, its concentration of risk, and the relationships between borrowers, investors, insurers, and financial intermediaries. Lex Greensill consistently defended the company's business model, arguing that supply chain finance remained an important financial tool when properly managed. But the collapse fundamentally changed how regulators, banks, and institutional investors viewed the industry. The problem had never been supply chain finance itself. The problem was allowing increasingly speculative assumptions, complex funding structures, and concentrated risks to become embedded inside a system that depended entirely on continuous confidence. Greensill Capital disappeared, but the questions it raised continued reshaping global finance long after the company itself was gone.
Greensill's collapse wasn't the end of supply chain finance. It was the end of believing that every invoice-backed financial product carried the same level of risk. The underlying idea survived. Helping suppliers receive payment earlier while allowing large companies to keep normal payment terms remains an important part of global commerce. Every day, billions of dollars worth of legitimate supply chain finance continues supporting manufacturers, retailers, pharmaceutical companies, technology firms, and international trade. What changed was how the industry evaluates risk. Banks became far more cautious about financing future receivables instead of completed invoices. Institutional investors demanded greater transparency into the assets they were purchasing. Trade credit insurers strengthened underwriting standards and placed greater emphasis on concentration risk. Regulators increased scrutiny of complex funding structures, interconnected financial relationships, and businesses that depended upon continuously refinancing themselves through capital markets. The collapse also reminded investors that diversification means more than holding thousands of financial assets. Those assets must also depend upon independent businesses, independent customers, and independent sources of repayment. If too much of a financial system ultimately depends upon the same small group of borrowers or the same supporting assumptions, the appearance of diversification can become an illusion. Greensill didn't prove that supply chain finance was broken. It proved that even an elegant financial innovation can become dangerous when growth outpaces transparency, when assumptions replace verification, and when confidence becomes more valuable than the assets themselves. The company promised to accelerate global commerce. Instead, it accelerated one of the fastest losses of confidence modern finance had ever experienced. Its offices disappeared. Its funding machine stopped. But its greatest legacy remains the lesson it left behind. In finance, the strongest systems are not the ones that grow the fastest. They're the ones that can still survive after confidence is tested.